This is the next big risk. I'm Sonali Basak. Across the world, risks are percolating from geopolitical strife to a stock market in the U.S. that's become increasingly concentrated in a handful of large technology giants. It's a job for an investor to navigate the next big risk. One corner of the financial world has expanded meaningfully in a bid to capture the investment opportunities of tomorrow, and that's private credit. We asked three giants of the nearly $2 trillion industry about what concerns them over the next 5 to 10 years. Purnima Puri, managing director at HPS Investment Partners, worries that changing demographics and dropping fertility rates will lead to a labor shortage that could stall U.S. growth. Jonathan Lewinson, co-founder and managing partner at Diameter Capital Partners, sees the deluge of misinformation and political identity threatening the objectivity of investors. And Josh Easterly, co-founder and co-CIO of Sixth Street Partners, wants to see a better education on the style of risk management required to succeed in private credit. But we begin with Purnima Puri. We discuss her concerns about the link of demographic changes to slowing U.S. growth. Over the 5-10-year horizon, what are the next big risks?
The big risk is growth, and within growth, potentially a labor shortage. And maybe that's an underappreciated risk that's floating out there. Aging population coupled with declining fertility rates makes for a shrinking workforce. And a shrinking workforce then makes for potentially lower growth or more reliance on productivity. So aging population, declining fertility are two really big components to organic population growth. So that keeps me up at night, because growth is population growth plus productivity, and population growth is organic growth plus immigration or migration plus productivity. So, depending on where we land on immigration, that could be an underappreciated risk in the market in terms of its contribution to how the economy's grown.
Do you worry about productivity and the ability for the U.S. to be productive enough to really fill the gap you're talking about?
I think you have a spend problem, which is that the aging population puts more pressure on what's needed to support that population over the long period of time that we're looking at. And so I worry about that. We've been tracking at high productivity, I guess, since the end of 23, and the numbers are close to 2%. And that's more than most other countries, by the way, also, right? But if you look at numbers over time, and McKinsey just came out with this report, they said, between 2012 and 2023, productivity in the U.S. is just sub 1%. And we need to get to just sub 2% in order to maintain where we are in terms of GDP. I think the underappreciated risk issue is that you're putting a lot of reliance on productivity, and it feels like we're in the right direction there, but it feels like there's lots of other variables that could upset the mix.
It seems like if you have an aging population and there's so much of the existing U.S. budget that goes towards supporting that, then how much of a problem is it that you don't have the fertility rates to support that growth rate?
Let's pretend that you get fertility from 1.66, I think is the number, to 2.1 today. It's going to take 20 years still. It takes a long time for that to be the only lever. So I go back to kind of just the math on it. And the simple math is population plus productivity equals growth, right? And so then if you double click to population, you say, okay, well, population is organic population plus migration. And so you do have a lever that could be helpful between now and then. And ultimately, the numbers I've seen, and these numbers are all over the place, but the numbers I've seen are that the aging issue is pulling roughly 500,000 people out of the workforce annually. So that's a drag of 15 to 20 basis points. So you're really counting on productivity to make up for increased expenditures plus a lower workforce. So then it gets into, so is the real risk labor shortage, and how do you plug the gap?
So people might be working a lot longer.
People are talking about a mosaic of solutions, but there's not one lever, right? Because fertility is not going to solve this because it takes 20 years. Cost cutting is not going to solve it because you're working within a band of what you can actually do. So you got to do all of it, right? You got to potentially, there's lots of countries that have put incentives in place for fertility and for birth. There's lots of countries that have put incentives in place for childhood education and retraining and reskilling. There's lots of countries that are trying to move the retirement age. Ultimately, by the way, people that are over 65 still consume a lot. And so the other problem is a lot of people made a lot of money in the markets and in rising asset prices, right? And they made a lot of money in that, and that actually helped a lot to support 65 and on when you're not receiving your paycheck. But there's been a lot of shifts in the way this whole thing works. And so when you look and you go back to the higher rate environment, do we increase 401k contributions in order to help incent people to save more, to have more when they're coming out on the other end? They need it for longer. But we need more alternatives for people to invest in order to support this longevity.
What about the diagnosis? If the diagnosis at the end is worries about growth rates, how do you get from point A to point B? Why do you worry so much about that end goal of better growth?
Because if we can't grow, you're going to have a much more inflated debt to GDP and federal deficit. And that's not good for the economy. You have a lot of burden that's being put in another generation, and that's going to create a lot of social strife. And so growth is really critical. And I think what's underappreciated is what the inputs are to get to the growth number. And so we talked a little bit about productivity, and I hope that we can continue to produce at 2% indefinitely on productivity. I think that would be great. But you got to make sure you have the other levers in place, I think, to buoy that. So if you look back over the last several years, we've had 8 million immigrants come into this country in the last 4 years. And that's helped growth. And by the way, that's deflationary.
You think investors are undercounting the risk? You've mentioned a couple of times that there's a few things that people are not really baking in around this math.
I think there's been more and more people that are focused on the debt problem and the deficit problem. So I think that risk of growth is what factors into those two problems. So I'm not sure that people are discounting it. What I wonder is whether there's been such a sea change on migration and attitudes towards it. I mean, I read an article recently, like 55% of Americans want immigration to be curtailed dramatically. This was like compared to like 41% a year ago or something like that. So I just wonder whether there's as much focus on the population piece of it, because I think there's a lot of people that are assuming we're going to be productive enough.
Coming up, Jonathan Lewinson, co-founder of Diameter Capital Partners. This is Bloomberg.